Let's take the discussion on markets forward with Manishi Raychaudhuri, who's joining us now. He's a veteran investor in Asian equities. Manishi, morning. Manishi, over the last few years, you've been looking, of course, you've been looking at India, but you've also been looking at China very closely. How's your Mandarin levels now? On 1 to 10, scale of 1 to 10, they may have been closer to 10 now.
我是印度人，但是我住在香港，所以我会说一点普通话。
I'll give it 10 on 10.
What I said,
Ni hao from Mumbai, but that's all I know about. But what I want to know about is Chinese valuations. Everybody here in India are saying that now in 2024, the flows will actually head to China from India, because India is an expensive market and have done phenomenally well last 2-3 years, and China is turning out to be pretty inexpensive. How do you look at, because you have an eye on both these markets, do you think this could be a trade-off for most of the FIs?
I think there's a merit in that argument. It's quite correct that Greater China equities, particularly Hong Kong and onshore China, are quite inexpensive. In fact, there are pockets where, I'm actually tempted to call them ridiculously cheap right now. The market is also under-owned, seriously. In contrast, when one looks at India, it's kind of priced to perfection. The valuations seem to be discounting not just this year and the next, but also maybe another 2 to 3 or 5 years. So I think this is now getting gradually reflected in the sort of consensus opinion or the consciousness of foreign investors. We have seen significant inflows into China over the months of February and March through the northbound Stock Connect. In contrast, if you look at India, January and February were quite pedestrian in terms of foreign flows. March was decent, but that also was taken up by, to a certain extent, to a large extent, by the IPOs and block deals. Right. So I think the foreign institutional investors are gradually waking up to the fact that while India remains kind of a bi-decadal story over the next 2 decades, 2 to 3 decades, it's going to be a core holding in their portfolio. And it's a long-term bull market with several fundamental factors falling in place. In the near term, I think the valuation concern is playing in terms of, the kind of pattern of flows that you're seeing right now.
Okay, so Manishi, since you're saying that the Chinese markets are quite inexpensive, Indian markets are priced to perfection, does it mean that you're tilting more towards the other emerging markets rather than India? What's the pecking order right now?
I think, from a foreign investor's perspective, India would still remain a core holding. But at the same time, tactically, there is a case for increasing weight relatively on the North Asian markets. And, in these North Asian markets, I would definitely include Hong Kong. I would definitely include onshore China. I would definitely include Korea. And notice that in many of these markets, including Japan as well, there's been a degree of, influence from the government in terms of directing the companies to create value for investors. There's been a significant uptick in buybacks, a significant uptick in dividend payment, and in some cases, even just better communication to investors. So we have seen that in Korea, the government urging private sector companies to create value for investors. We have seen that in Japan. We have seen that in certain directives from the Chinese authorities as well. And I think this is, it underscores the fact that the governments are also conscious of the fact that they need to bring in foreign investments into these markets, and they're acting towards that end.
Right. Manishi just specifically wanted to address what's happening within the small and mid-cap space here in India, right? I mean, a sizable correction is already out of the way, it seems. And that's where the insatiable appetite as well is. Even in the recovery which has happened in just the last 2 odd trading sessions, is the mid and the small caps which are most sought after. What is it that you're making of this sort of disconnect we have here within the large caps and what's happening with the broader end of the market?
I think despite the correction that we have had in the mid and small caps over the past 1 month or so, it's still very difficult to find pockets of reasonable valuation, growth at reasonable valuation in these universes. So I think the fact or the tendency of investors to sort of move towards large caps, which we had seen in the early part of this year, I think investors should still adhere to that kind of an action on the market right now. If you look at the price earnings multiples, even the broader indices, the mid and small cap indices, are possibly in the range of about 25 to 40. They're not really, I mean, not in a case of every stock is it justified by the future growth projections. In case of large caps, on the other hand, there are a few sectors that have underperformed. Private sector banks, for example, some notable good quality private sector banks have underperformed for the past 3 years. So I think there are some interesting pockets that have emerged in the large caps, not quite so in the mid and small caps.
Manishi, I want to talk about one area of the market which has rewarded investors in the last 2-3 years, then went in a sideways kind of a phase. I'm talking about the manufacturing and premium capital good companies, which are actually catering part to the country and part to the world. Now there are specific manufacturing funds being raised here in India. Viksit Bharat Ambition 2047, what kind of target? So there are two narratives coming. One, Indian really truly manufacturing plays have become expensive. The other, well, the narrative may be good, but India, the manufacturing dream of an ambition of ours may not be very easy to achieve, just like China did in the last 2-3 decades. So should one be riding behind these names? How do you make of this conundrum?
Right. So in terms of government policy and the momentum in favor of manufacturing, there's certainly a case for a long-term bullish opinion to be formed on this. That narrative I would tend to agree with. And on top of that, we're in a geopolitical situation that favors some degree of alternative supply chains being created. If India is, sort of able to place itself in that supply chain momentum, in that, supply chain creation, then certainly there's a case to be made for a long-term bullishness for these stocks. At the same time, there are certain things that I think they're still not in place. For example, these kind of supply chain creation needs a significant degree of skill creation as well. I mean, do we have the number of people, the kind of people with adequate skills in these activities? I think that is what the jury is still out on. That is what the investors would be looking at over the next few years. To kind of make up their mind as to whether these stocks would be long-term successes or whether some of them would fall by the wayside.
Okay, point taken. But Manishi, what do you make of the future of the banking sector in India? Because of course there has been this entire regulatory overhang which has been there. But overall there's this expectation that credit growth is going to slow down a bit. The interest rates are going to turn as well. What's your view on how the banking sector is placed right now?
If we look at the, let's say, forget about India over the next 2-3 quarters, but look at the next 5 years, 10 years, or maybe a couple of decades, then if one has to play broader economic growth, then one has to play the banking sector. Because think about it, the economy is ultimately private consumption, government spending, investments, and net exports. Right. So out of these, at least two significant segments are driven by the banks. They're supported by the banks. Therefore, the growth in the banking sector is almost inextricably linked to the growth in the broader economy. And if we believe that a real GDP growth of, let's say, 7%, a nominal GDP growth of 10 to 11% is the order of the day for the next decade or so, then there's no escaping from the narrative that the banks would be a significant participant in that growth. Now, having said that, there are some banks which would significantly gain market share, and these are the private sector banks. Even after, they've been around for almost 30 years, still, I think about 65 to 70% of the market share is still with the public sector banks. And that would obviously get whittled down as we go along. The private sector banks also have the advantage of far better asset quality on the average. So I would seriously, focus on the private sector banks. Yes, I know that there have been concerns about a decline in CASA, current account and savings account, because money has moved to the equity markets and not away from the banking deposits. But I think those are, really short-term hurdles or short-term headwinds. And if you're able to look beyond them to the long term, there's no escaping from, a long-term bullishness on the banking sector.
Right, Manishi, so great to have you on the show. Thanks as always for taking the time out and speaking with us.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.